The global economy stands on the brink of an unprecedented collapse, and the warning signs are no longer whispers in the background. They are deafening alarms. What if I told you that governments worldwide are teetering on the edge of failure, with financial ministers resigning in droves as the weight of their lives becomes unbearable? What if the carefully crafted facade of economic stability is nothing but a thin veneer hiding a catastrophic reality? What if your savings, your job, and your future are already being consumed by a financial system that is collapsing under its own weight? This isn't hyperbolic, it's happening now, and the cracks are spreading faster than anyone dares to admit. In a previous video, I discussed how the RBI governor's move to protect the rupee from falling by trying to scare off speculators and shorting the dollar is a very short-sighted move that would end up exposing the RBI to more risk. And looks like I was right. Against the rising dollar, the rupee continues its collapse. Inflation is extremely high and a new governor, Sanjay Malhotra, takes lead. Across the globe, the fabric of modern economies is unraveling. From Canada to China, from Germany to Brazil, governments are falling apart under the strain of their own deficit. Political leaders insist that everything is under control, even as unemployment rises, currencies plummet, and people struggle to make ends meet. But here's the grim truth. This is not a story of unfortunate events or minor miscalculations. It's a calculated dismantling of public trust and wealth, orchestrated by those who claim to protect us. By the end of this video, you will understand why the collapse is becoming inevitable and ordinary people are the ones paying the price. The collapse of global governance. In Canada, Finance Minister Chrystia Freeland recently resigned amid a storm of political and economic turmoil. Prime Minister Justin Trudeau's administration, which has repeatedly painted a picture of economic strength, is facing widespread backlash. Behind the carefully crafted facade of economic recovery lies an unemployment rate near 7%, the highest outside of pandemic times, and a GDP growth rate which has stalled. Canadians are watching their purchasing power evaporate while their government insists that inflation is under control and economic prospects are bright. Germany and France are no better. In Germany, Chancellor Olaf Scholz's government has collapsed under the weight of no confidence votes, the sixth of his tenure, while unemployment and labor unrest mount. France's Emmanuel Macron is on his fourth prime minister in just over a year, with political instability and economic mismanagement driving his administration's approval ratings to historic lows. These governments have blamed political opposition and external shocks for their failures. But the truth is much simpler. Their policies have deepened the economic malaise they were elected to solve. The common thread tying these collapsing administrations together is their reliance on lies to maintain power. They have claimed that their economies are thriving, that inflation is under control, and that their fiscal policies are sustainable. These are deliberate distortions designed to pacify the public while their economies rot from within. Central banks, meanwhile, have become willing accomplices in these deceptions, creating the illusion of recovery through monetary gimmicks like quantitative easing and rate cuts. But as the real economy deteriorates, these illusions are shattering, leaving behind a populace that is poorer, angrier, and increasingly aware of the betrayal. The illusion of recovery and the role of central banks. Central banks have sold a dangerous fantasy that they have the power to control inflation, stabilize currencies, and foster economic growth. Yet, all evidence points to their impotence. In the United States, Federal Reserve Chair Jerome Powell's recent rate cuts have been accompanied by promises of economic expansion and controlled inflation. But the reality is starkly different. The dollar's relentless rise is wreaking havoc on global currencies, and the financial conditions are tightening to the point where a full-blown currency crisis is imminent. Quantitative easing and rate cuts, heralded as tools to rescue economies, have instead laid the groundwork for disaster. It involves central banks creating money to purchase government bonds and other assets, which supposedly stimulates economic activity by lowering borrowing costs and encouraging spending. However, in practice, quantitative easing inflates asset prices, stocks, real estate, and bonds, benefiting the wealthy while doing little for the real economy. The money created often does not reach the pockets of ordinary citizens or businesses that need it most. Instead, it circulates within financial markets, creating bubbles that inevitably burst, as we are now beginning to see. Rate cuts, meanwhile, are meant to make borrowing cheaper, theoretically spurring investment and consumption. But in an environment where household debt is already sky high and businesses are hesitant to invest due to economic uncertainty, rate cuts lose their effectiveness. Lowering interest rates further cannot compel people to spend money they do not have or businesses to invest in markets with declining demand. This is why we are seeing credit growth stall globally, including in India, where it has plunged from 20% to just over 10% in a matter of months. The dollar's rise exacerbates these failures. In a global financial system dominated by the US dollar, countries reliant on dollar denominated debt face soaring repayment costs as their local currencies weaken. Central banks can't print dollars. They can only intervene temporarily by selling reserves or raising rates, both of which are unsustainable. In Brazil, despite massive rate hikes and $17 billion spent in a single week to prop up the real, the currency continues to plummet. Understanding the mechanisms of collapse. To understand why this is happening, it is crucial to break down the factors driving the collapse in terms that anyone can grasp. Inflation and eroding wealth. Inflation, the increase in prices of goods and services, is one of the most visible signs of economic distress. For ordinary people, this means their money buys less over time. Instead of addressing root causes, governments are manipulating inflation statistics to downplay the crisis. Behind these numbers lies a stark reality. The relentless rise in prices for essentials like food, fuel, and housing, coupled with stagnant wages, which has left millions poorer and struggling to survive. In India, inflation is compounded by a weakening rupee, which makes imported goods more expensive. This drives up the cost of living, forcing families to spend more on basic necessities and leaving little to no room for savings. And what is the government's response? A raft of regressive taxes targeting the poor while shielding the wealthy. Taxes on fuel, basic goods, and small businesses disproportionately affect the most vulnerable, who are already grappling with diminishing incomes. Inflation is the cruelest tax of all, economist Milton Friedman famously stated, and this truth resonates painfully in India. The government's reliance on indirect taxation, often described as a tax on survival itself, has become a tool to exact resources from the poorest segments of society while corporate giants benefit from tax breaks and subsidies. Nobel laureate Joseph Stiglitz warned, when inequality grows, it weakens overall demand, further stalling economic growth. A grim cycle clearly at play in India's faltering economy. Let us next discuss the collapse in hiring. Unemployment is a key indicator of economic distress, and nowhere is this clearer than in India. Job creation, essential for growth and stability, has collapsed as businesses cut back on hiring due to economic uncertainty. Rural agricultural workers, unable to sustain themselves, are migrating to cities only to find non-existent opportunities. This migration further exacerbates overcrowding and strains public resources, deepening the crisis. The root cause of this joblessness lies in systemic failures orchestrated by governments that prioritize industrialists and foreign investors over their own people. A recent report by Oxfam India revealed that the richest 10% of Indians control 77% of the nation's wealth, leaving the rest to scramble for scraps. Economist John Dries highlights India's labor market is rigged to benefit the elite while majority struggles without social security or fair wages. This lack of jobs creates a vicious cycle with fewer people employed, consumer spending plummets, weakening demand, and further discouraging businesses from expanding. Debt and credit play an important role. Debt is a silent killer in today's economic crisis, particularly in emerging markets like India. Encouraged by years of low interest rates, governments, corporations, and individuals have borrowed heavily only to find themselves trapped as global financial conditions tighten. As the rupee weakens against the dollar, the cost of servicing dollar denominated debt becomes unsustainable. India's credit growth has plummeted, dropping from 20% to just over 10% in a matter of months. This signals a credit crunch, as banks and lenders are wary of rising risks and are pulling back from extending new loans. Without access to credit, businesses cannot expand and consumers cannot spend, grinding economic activity to a halt. Economist Raghuram Rajan and former governor of the Reserve Bank of India describes the situation as economic cannibalism. Policies that favor short-term gains for the wealthy at the expense of long-term stability for the majority. Adding to the crisis is the government's alliance with big investors and corporations. While small businesses are starved of funds, large industrialists receive preferential treatment, subsidies, and bailouts as well. This blatant favoritism not only deepens inequality but also saps the economy of dynamism and innovation. When the government serves the interests of the few, warns economist Thomas Piketty, society as a whole suffers. Growth becomes unsustainable and inequality tears at the social fabric. What is the human cost of all of this? The impact of these policies is measured not in statistics but in lives. Urban workers face skyrocketing rents and stagnant wages, while the middle class families are forced to dip into savings just to cover basic expenses. The dream of upward mobility has turned into a nightmare of survival. The government's regressive taxation policies compound this suffering. In this environment, the rich grow richer while the poor are abandoned to their fate. Economist Amartya Sen observes economic growth without social justice is empty growth. It breeds resentment and instability. In India, this instability is already visible as people are increasingly frustrated and are demanding reliefs from crushing economic pressures. Yet, the government's response has been to suppress dissent while simultaneously fanning religious fervor and social conflict. By amplifying divisions along religious and communal lines, the government seeks to deflect anger away from its economic mismanagement and channel it into manufactured culture wars. This deliberate strategy diverts public attention from policies that widen the gap between rich and poor and erodes the solidarity needed to demand real systemic change. This approach is not just unsustainable, it's a deeply cynical and immoral. India, a nation enslaved by the system. India exemplifies the plight of the common citizen in this collapsing global order. For years, Indians were sold the dream of economic prosperity, growth rates were touted as the proof of success, and stock market highs were paraded as evidence of a booming economy. But beneath this veneer lies a grim reality. Ordinary Indians are powerless against a system designed to exploit them. First comes the illusion of stock market growth. The stock market is often celebrated as a barometer of economic health, but in India, it has become a mirage that hides deeper economic failures. In 2021 alone, over 60 companies launched IPOs, collectively raising more than 1.2 trillion rupees. Many of these highly anticipated IPOs, such as Paytm, saw catastrophic declines. Paytm's shares plummeted over 70% from their listing price within months, erasing billions in investor wealth and disproportionately affecting retail investors who had poured their life savings into these stocks hoping for returns. This speculative growth does not reflect a healthy economy. Rather, it is fueled by liquidity injections and media hype orchestrated by institutional players. The common people with little to no understanding of market dynamics are left to bear the brunt of these speculative bubbles. As stock prices crash, wealth is not just lost but effectively transferred from the many to the few who control these systems. The rupee and the economic squeeze. The rupee's relentless fall against the dollar, now hovering around an all-time low of rupees 84.95 to $1, is not merely an economic concern. It is a daily struggle for average Indians. Essential imports like fuel, which constitutes nearly 85% of India's crude oil needs, and medical supplies have seen price surges contributing to retail inflation rate of over 6%, persistently above the RBI's target range. The depreciation directly impacts household budgets, with over 40% of rural households now reporting an inability to meet monthly expenses. This erosion of purchasing power creates a cascading effect. Reduced consumption, stagnating businesses, and rising unemployment further weakening the economic fabric. All of this is further exacerbated by speculative policies and the fiscal cliff. The government's reliance on deficit spending and debt driven policies has created an illusion of growth. But the cracks are widening. India's fiscal deficit has ballooned to 6.4% of the GDP in 2023, far exceeding sustainable levels. Much of this deficit is financed through borrowing, with public debt now at a staggering 85% of GDP. Infrastructure projects, often touted as symbols of progress, remain incomplete or fail to deliver promised benefits. For instance, the ambitious Smart Cities mission has spent only 50% of its allocated budget since its launch in 2015, with most of the projects still in the planning phase. All of this has resulted in people concluding that the game is rigged against them. The stock market's speculative nature, the rupee's decline, and misguided fiscal policies all point to a system rigged against ordinary citizens. Economist Kenneth Galbraith once remarked, "The stock market is not the economy, and India's current state proves this beyond doubt." While the wealthy and institutional investors manipulate the system to their advantage, the common people lacking financial literacy and resources are left vulnerable to the fallout. For instance, data from SEBI reveals that nearly 90% of retail investors who entered the market during the pandemic have faced losses. Meanwhile, corporate giants and foreign institutional investors continue to dominate, reaping profits even during market downturns. The coming grim reality. As the illusions fade, the grim reality becomes clear. The global economy is heading into a depression, and the fallout will be catastrophic. Emerging markets will face currency collapses, defaults on dollar denominated debt, economic contractions that will plunge millions into poverty. Advanced economies will not be spared. The rising dollar will suppress exports, weaken manufacturing, and drive unemployment higher. In India, the impact will be devastating. The government's attempts to spin this as a temporary setback is sure to fail, as ordinary Indians see their savings wiped out and their opportunities disappear. The political fallout will be severe, but the economic damage will be even greater. A generation of Indians will be left to pick up the pieces of a broken system that failed them at every single turn. Governments have lied to their citizens, central banks have failed to fulfill their mandates, and the global financial system has been exposed as a house of cards. The victims are the ordinary people who entrusted these institutions only to be betrayed. The coming months will reveal the full extent of the damage, and it will be the people, not the policymakers or the bankers, who will pay the price. This is the grim reality of the world that we live in. And it is one that demands not just acknowledgement but action. This time for illusions is over. The storm is here and there is no escape. Thank you for watching till the end. Please let me know what you think is going to happen in the comments below. And I also request you to subscribe if you like this video.